Welcome back once again. So there's the final piece of our second installment, the one that I was emphasizing on a view of our synthetic indices. And in this case, we have Crest 1000, and we'll be dealing with a cell setup that occurred on this level right here, the one that I'm pointing at right now, all the way to this area right here. Well, there's a setup that we took in our group. We took the setup. It was very good sell. So let's dive into it. So we had this bearish breaker on the daily time frame, and we said for our long-term perspective, it has to be the daily or the 4 hour. That's where we mark out our long-term highs, long-term long-term high or the long-term low, right? So we had that right there, and on the 4 hour, interestingly, we had this 4 hour bearish order block. So it gave us more confidence in this setup. This is what we call, it's a concept called nested PD arrays. It's there on the strategy. It will be there on the mentorship. Um, it's pretty much detailed, really. It's pretty much detailed. So let's dive into it. Let's dive into it. We have our key level, which is our high time frame level of resistance. In this case, we're dealing with highs, so we're not dealing with lows where we had our high time frame level of support. So I just wanted to give you a different view of the market since we were dealing with a buy setup at the futures market. So yeah, we can establish what? We can establish our long-term high right here because there's the swing high that is retesting what? Our high time frame level of resistance. So we can go to the 1 hour to find our intermediate term levels, key levels. The 1 hour, there we go. And interestingly, this class is going to be interesting. It is going to be very interesting because we have more concepts accompanying the advanced market structure. Before the end of this video, you would have learned something new again, something more exciting, because that is what we bring. We bring exciting and insightful tools. So yeah, we have this long-term high, right? And then we said whenever the market goes back to do what? To rebalance an imbalance formed on this rally, it would form what? It would form an intermediate term high. Intermediate term high right there. And we said the intermediate term high should not be broken. The same way the long-term high should not be broken, the intermediate term high should not be broken by further retracement. And then we have another what? We have another intermediate term high because it is rebalancing an imbalance on this price rally. You see it. So whenever the market goes back to rebalance an imbalance, it forms what? An intermediate term high. All right. So I'm not going to go into details about how we entered into this trade, but we had so much confidence in it. I could possibly bet my life on it at the time that it was panning out. We have the befores and afters that you can only find when you're part of the group. We have our server, we have our YouTube channel, we have everything is literally at your disposal. And the Discord server is fully packed with revision materials and everything that you'd expect from IPDA Insights. Anyway, let's proceed. So let's look into what happened in this rally on the 15-minute time frame, 15 or the 30-minute time frame. I'll go to the 15-minute time frame so I can introduce a new concept right here. So we can see how this long-term high, intermediate term high, and the other intermediate term high held all the way and up until the market part traded into our target and this last target before we saw a reversal. So let's go to our 15-minute time frame. It's going to take a little while. That's what we're dealing with because of our trading view. It's not similar to the one you saw for forex and futures markets. There's a little bit, it's a little bit reluctant and not so, not so smooth, not so smooth. So give it a moment. It's still coming through. It'll definitely come through. Let's try the 30 minutes. All right. It took a little while, but we managed to load our 15 minutes time frame. So, we can see our intermediate term highs and the long term high holding nicely as price rally down to our target, right? So, there's more to this concept as I had mentioned before. Um, in this episode, we have what we call the three drives pattern. The three drives pattern. What is a three drives pattern? It is when the market is continuously making short-term highs, as it did here. That's the first short-term high taken out, second short-term high taken out, and we have the third short-term high right here, which formed what? The intermediate term high in our advanced market structure key levels. So what it entails is that whenever the market is taking out the short-term highs and approaching a liquidity pool or a key level, then we do not need to see the market taking out that key level. So we're already using what? The concept of this being an intermediate term high because it is rebalancing imbalances found here and the fact that it is making the three drives pattern. What is the significance of the three drives pattern? This is how smart money establishes their new sell positions. They sold here above this high, they sold here above the short-term high, and they sold right here before this rally to the downside. Smart money sells above old highs and buys below old lows, which is the opposite for retail traders who be buying breakouts above old highs and selling breakouts below old lows. So that is the difference between us IPDA traders and retail traders with their retail perspective. So how do we proceed from this? The three drives pattern entails that after the third leg is formed, which does not need to take out our liquidity pool, then we need to see what? We need to see an obvious displacement. What is an obvious displacement? It is an energetic move to the downside that takes out what? Swing low. We can see how the market was in a hurry to take out this swing low. So with all those confirmations on your side, you would bet your life on this setup. The same way I mentioned that I would have literally bet my life on this setup because it gave me all the confirmations that I need from market structure. We're not talking about breaking highs and breaking lows and all that. Here, we're talking about advanced market structure. This is not technical analysis. This is technical science. I've already mentioned that from the first episode that we are not doing anything that is related to the retail logic. We're not doing, what do they call it? We're not doing the likes of the head and shoulders and whatever. People don't even know what the head and shoulders entail and how it comes about. But if you are to use this concept, collaborating it with what? Liquidity concepts and bias and all other concepts that are found on the strategy, then you definitely get it. And you'd never doubt your setups. And while I'm looking at the 15-minute time frame, because there's my ideal time frame for entries, I'm seeing entries that I took on the previous trades that I took from this particular move. I'm seeing entries all over because why? I trusted that this market was not gonna keep on riding to the upside. So For example, you could have been a buyer here. Just an example. I'm not saying that is how we enter our market. Could have been a buyer right there, and your stop loss would be where it'll be. It'll be where I said the market should not break. I said the market should not break what, a long term high, and it should not break what, intermediate term highs. So if you know that, if you are well aware of that concept, then you can confidently put your stop loss at the right areas and not without having any fuss about the particular move. So we can see how it traded all the way to our target, all the way to it, all the way to our target reached, and then the last part, target reached. And honestly, all these moves that we are trading using this concept and the pattern concept, which is not being taught on the free content, because like I said, there's the foundation, there's the basis for our strategy and what will be taught on the mentorship. So I hope you took some notes on this one. It was quite interesting, I would say. Three drives pattern versus advanced market structure key levels. And just like that, you have it your way. As we meet again next time, try revising through this material, try memorizing, or not memorizing per se, but try studying it to the last bit, because you can actually see. I don't need to prove nothing to you. Just go into your charts and look at your charts and actually look at the hindsight moves and actually study them from the daily or the 4 hour to the one hour and even the 15 minutes per time frame rather, and look for something of this kind. Look for the three drives patterns, the intermediate term highs and lows. Just look at that. You actually see that it has always been there, but it is not being taught anywhere else. It is not being taught in books. It is not being taught on YouTube on retail traders streams and all that. It is solely dedicated to what, IPDA traders. So if you are a trader who want to trade in sync with smart money, then this is what you need to be studying. This is what you need to be looking for in price. Nothing more, nothing less. Stop with the higher highs and breaking lows and then you see a reversal. No, it doesn't work that way. It doesn't work that way. That is very much inconsistent. We want something that is confined to certain rules. And that's what makes this a technical science analysis. With that being said, thanks for listening. We'll meet again on the third installment, which will be dealing with possible entries and probably another interesting aspect or prospect that I'll throw in there just to keep you all entertained. Thanks.